What does it mean when a company buys back its own stock? So in this video, I'm going to tell you why does a company buy back its own stock, how to tell if a company buy back. I'm going to give 3 reasons why it buys back, how to tell if a company buys its own stock, and what exactly does it mean. We always see it all the time where this company purchased its own shares or brought back its own shares, right? Is that a good thing or a bad thing? We're going to get to that in this video. But first, hit the subscribe button, hit the bell icon, hit that like, comment, and share button. Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into the Investor Show. As always, this is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. So, ladies and gentlemen, I'm talking about companies that buy back their own stock. What does that mean? So a company is essentially what it says. A company like, let's say Visa. Visa buys back their own shares. What does that mean? So when a company buys back its own share, this is exactly what's happening, right? It boosts up its earnings per share. So let's say the company's net earnings, company A that we have here, has a net earning of $10 million. It has 500,000 shares outstanding. And we can see to get EPS, earnings per share, we divide net earnings by shares outstanding, and that comes out to $20, right? Now, let's say the company decides, hey, I want to buy back my own stocks. So people say, okay, well, I want to buy back my own stocks. How does that affect the stock price? Now, let's say if company A decides to buy back 100,000 shares of its own company. So now it still has the same earnings of 10 million, I meant to say. Now it only has 400,000 shares because it brought back 100,000. Now you're looking at an EPS, earnings per share, of $25. You see how it went from $20 to $25, how it boosts up the company? This itself, it reduces the amount of shareholders out there. It boosts up the value, the book value of the stock, makes the stock look more attractive, raises the stock. Now the question is, okay, Prince, why would a company buy back its own stock? And this is why I kind of pay attention to this as well. One, in order for most of the time, companies that buy back their own stock usually have a pile of money, a pile of cash that they don't know what to do with, right? I won't say they don't know what to do with. They don't have that many alternatives. They may feel like buying stocks are overvalued. They may feel like other stocks are overvalued or whatever the case may be. And then they have to have a pile of cash. Why do I care if a company has a pile of cash? It's a good thing if a company just has a pile of cash laying around. If a company has little to no debt, it has a pile of cash, and it starts buying back its own stocks, that's a good thing. Because, just financially, if somebody has a bunch of money laying around, I like that. So this is kind of why I pay attention to a company that consistently buys its own shares. Now, if it's buying it with debt, you got to look a little bit deeper. But if it's buying it with straight cash because it just got cash laying around, that could be a good thing. Number two, they feel their own stock is undervalued, right? For a prime example, they may look at the market and say, man, the best stock on the market right now is Visa. Our company is the best stock on the market. So when you see a big company buying back its own shares, it's a good indicator that it could think that its own stock is undervalued. And everybody loves to copy and follow big money. So if a company won't buy back its own shares, that means that it may think it's overvalued. Now, next, better than dividends. Number three. Why do I think it's because a company, when it has a pile of cash, it can do two things. It can buy back its own stocks, or it could issue dividends. This is how it can pay money to investors. Now, if it pays money to investors in dividends, then investors in return have to pay taxes, right? Every time we collect a dividend check, that's great, but we could have to pay taxes. Depending on some ways to get around that, but in general speaking, you have to pay taxes on dividends. So the company says instead of paying dividends, what if we just buy back our own shares, and by buying our own shares back, it can push the price of the stock up, earnings per share up, which can inversely push the price of the stock up. So what do people want? Do they want the stock price to go up, or do they want to get dividends? Depending on your investment strategy, but most people in general say, hey, you know what? Avoid the tax man and buy back shares to push up the value of my stocks. Number four. It increases the EPS, earnings per share, like we just saw in the last video. It still had the same earnings. The company had $10 million net in earnings. And guess what? It still had the same earnings, but the earnings per share went up. Why did it go up? just because they reduce the amount of shares on the market. So in reverse, this makes the company look more attractive. It makes the book value look better. It makes the earnings per share increase. That's what people like to see, right? Now let's get into the question. Okay, Prince, that's cool. You taught me a lot. How do I know if a company brought back its own shares? You guys and girls guessed it on the 10K report and the 10Q report, which we're going to look up right now. I'm going to tell you exactly where to look at to find and to see where companies report their buying back of shares. So right here, we have the 10Q for Visa. This is their 10Q quarterly report. As we stroll down their quarterly report, we see their balance statement. So what we're going to do, you have all type of balance, not all types, but you got operations, income, balance sheets. What we want to do, we want to go to the cash flow statement. Now that we're here in the cash flow statement, you see the cash flow statement is broken down into 3 sections: operating activities, investing activities, and financing activities, right? Right up on the financing activities, what does it say? Repurchase of Class A stocks, right? So right here they're saying, hey, they spent $5.5 billion in their own shares. I think this is written in millions. Let me double check. Yes, it is. This right here says it right here. It's written in millions, so that's $5 billion. $5.5 billion Visa bought up his own shares on this 10Q report last quarter, right? It also issued dividends. It also paid $1.3 billion in dividends that it paid out to its investors. So right here, up on the cash flow, up on the financing activities, you can tell if a company is consistently buying their own shares back. Some people call it buyback, some people call stock repurchase, all of the good stuff like that. But anyway, I hope that helped you guys and girls out. Don't forget to hit that like, subscribe, comment, and share button. My name is Prince Dykes. This is the Investor Show. Until the next video, podcast, cartoon, or whatever else you see me do crazy around the globe, peace. Be safe. I'm out, and thank you.